So today we are checking IS number 30 as our topic. That is disclosure in the financial statements of a bank and similar financial institutions. Yeah, that is how the standard wants it to be. So I'll share with you a one-page note there, which I want us to go through. So open your, I don't know why I did not share yesterday. Mungeandika mapema, will have saved us time, but no problem. You'll just leave a page. So let's go through the notes, check. I'll share with you in your group. Yeah. So the objective of International Accounting Standards number 30 is to provide appropriate presentation and disclosure standards for banks and similar financial institutions in order to provide the users with appropriate information in evaluating the financial position and performance of a bank. Fine. So presentation and disclosure. A bank's income statement, that is the profit and loss account, should group income and expenses according to their nature. A bank's income statement should report on the following. Number one, they should report on the interest income, interest expense, dividends income, fees and commissions income, net gain stock loss from investment securities and foreign currencies, other operating income and expenses, loan losses, and general administrative expenses. So the main source of income for these banking institutions is always the interest which they get from, mostly from giving loans to the customers. So when presenting the statement of profits or loss, which we are calling the income statement, you need to focus majorly on the main source of income, which is the interest. So you check all the interest they generated from giving out loans, the interest which they generated from other investments. Then again, you check the expenses which were incurred in generating such income. A bank statement of financial position should group assets and liabilities by nature and list them in liquidity sequence. So for banks, when we are going for the presentation, and take this keenly, don't bother about non-current assets, current assets, and what have you. You just give us assets. You don't separate the two as current and non-current assets. Just give us all the assets. And more importantly, they want those assets to be grouped in liquidity sequence. Liquidity sequence means you start with the one which is easily convertible into cash. So unlike these other commercial entities where we start with non-current assets, property, plant, and equipment, here we normally start with the cash itself. Most of the cash which is held by the central bank. So you start with the cash in that liquidity until actually you're supposed to finish with the one which is least liquid. property, plant, and equipment should always be the last down there. The same with liabilities. You just give us the one which are easily convertible into cash. Disclosure requirements. So what you need to disclose to us, specific contingencies and commitments, including off-balance sheet items. Off-balance sheet items include transactions which were carried out by the bank and which should not be recorded in the financial statement of the bank until they are honored by the customers. Examples include future forward contracts, letters of credits, and guarantees, etc. So contingencies, you know, it means subject to. That is the meaning of contingent, subject to. So when you have presented the financial statement, you need to give us the disclosures, the explanation, the information. So you just tell us items like letters of credit, guarantees, future forward contracts, which the bank entered into. You see, future forward contracts, their execution will be in the future period. So you don't have to recognize. We do have what is called recognition and disclosure. Recognition is when you are capturing it in the financial statement. Disclosure is when you are just communicating about it. So you see, like future contracts, the execution will be in future. They are contingent actually. So you don't have to recognize them in the financial statements. Rather, you just give disclosures. So when you go to the questions, and the examiner tells you that the bank had acted as a guarantor for customer X on this and that and that. Those guarantees, even if they're quantifiable monetary, you don't have to bring them in the financial statements. You just give disclosures. So guarantees, letters of credits, future forward contracts, those ones you just disclose. Instead, you are not supposed to recognize them in the financial statements. Also, you need to disclose losses on loans and advances. Concentration of bank assets. Concentration is where most of their assets are found. You need to tell us, like, for example, if it is equity, they need to tell us most of the assets are concentrated at equity center. Then general banking risks, e.g. interest fluctuation risks, assets pledged as securities, they need to tell us. IFRS 9, so this standard is being affected by IFRS 9. IFRS 9 talks of financial instruments. The financial instruments are the bonds, the debentures, and the rest. So banks normally trade on these securities a lot. They trade in financial instruments a lot. So there is always connection between IAS 30 and IFRS number 9. So IFRS 9 requires that banks and other financial institutions to evaluate the economic and credit changes and their effects on lending to customers. The standard requires a bank to make sufficient provision for doubtful debts in relation to the amounts of lending to customers during the financial period. You know, IFRS 9 on financial instruments, when we try to move ahead, there is what is called hedging. To hedge is to mitigate. Hedge is a fence. So before you issue the loans, hii kitu wanafanya, ukienda kukopa loan wanafanya na Credit Reference Bureau, CRB, and that is hedging. You try to assess the possibility of the risk before giving out those loans. And in the event that you give out the loans, you are supposed to make provision for doubtful debts, which we call the expected. We call that expected credit loss, ECL. So you make sufficient provision that maybe there is a loss which might arise, and you recognize it in the books as doubtful debts. So you leaving that one page, which you will write, there is something which I want to modify in my notes, which is not there. I want to modify kidogo, then we'll move ahead. So that one you will have to write. That one you will have to write. So mjipange hapo mbio mbio. Mjipange hapo mbio mbio, tuandike something small. Then I think we can move forward. So write for me there some terminologies, just terminologies like that, then we are good to go. Terminologies. There are some terms which we can just brush off. Number one terminology is this one here. Let me start with this. Expected credit loss. We'll be calling this one most of the time ECL. So zoea your word ECL. Expected credit loss. Expected credit loss, popularly known as ECL. So right there and say, right there and say about the expected credit loss is the total amount, stroke loss that a bank expects from the loans issued. Loans issued to the customers. Loans issued to the customers. Loans issued to the customers. Full stop, another hyphen. It should be provided for. It should be provided for. It should be provided for as a doubtful debt. Should be provided for as a doubtful debt in the financial statements. A doubtful debt in the financial statements. Full stop. Let's go to number 2. They will catch up with us. Exposure at default. Number 2. This was number 1. Number 2, exposure at default. Exposure at default, mostly that one will be calling EAD. EAD, exposure at default. Exposure at default. Exposure at default. Then you say represents the outstanding. Represents the outstanding. Represents the outstanding amount of loan. The outstanding amount of loan. The outstanding amount of loan at the time of default. Let's just bring those kizungu nyepesi. Outstanding amount of loan at the time of default. i.e., that is, i.e., is the amount exposed. Is the amount exposed to the risk of default. The amount exposed to the risk of default. Full stop. So before we go to the another term, I'm just trying to bring them in a word which we can understand easily. You gave out a loan of 20 million. Alafu, the person who was given the loan, unasikia ni huyo mtu akuna case kotini na hiyo case ni mbaya sana, anaweza kuwa declared bankrupt. So you are 50-50. This person can be, once declared bankrupt, you cannot pay debts. So as an accountant, you need to make provision in the financial statements. And when making provision, if you are 50-50, you will say of this 20, 50% is doubtful debts. So the 50% of 20, that is the expected credit loss. The 20 itself is the exposure at default. So the exposure at default is the total amount of loan which was outstanding at the time you suspected the customer may default. So examiner ikwambia the exposure at default was this much, then that's the total amount at the time when you suspected the customer may fail to pay. Then when you multiply or you try to make provision on the amount which might not be paid, then that is now the expected credit loss. Let's go to the next one. Probability of default. Probability of default. Probability of default. So probability of default, tunaitanga PD. Probability of default. PD. That one we normally call PD. Probability of default. You say, is the likelihood that the borrower will fail. The likelihood that the borrower will fail to pay back the loans. The borrower will fail to pay back the loans. Full stop. It represents, or it reflects, it reflects the credit rating. It reflects the credit rating. It reflects the credit rating. Full stop. So that is the probability of default. I go back to what we were saying. The bank gave out a loan, total loan which was given out was 20. The probability that these people may fail to pay is 50%. So 50% itself, that rating, 50% is the PD, the probability of default. But once you multiply 50 times 20, which you get 10, so 10 is the expected credit loss. So once you calculate the amount you expect, which might is considered to be doubtful, that is the expected credit loss. But the percentage itself is the probability of default. Then the 20, the total amount which was being suspected is the exposure at default. Last but not least, loss given default. Loss given default. This one we tunaitanga LGD. Loss given default. Loss given default. Then we write there and say, on the loss given default, is the estimated amount of money that a bank or other financial institution, the estimated amount of money a bank or other financial institutions loses when a borrower defaults on the loan. Loses when a borrower defaults on the loan. Hivyo tu. And I can repeat, the estimated amount of money a bank or other financial institution loses when a borrower defaults on a loan. So LGD sometimes can confuse you with, it can confuse with which one? I think it can confuse someone with ECL. Because ECL is the doubtful debt itself, the amount you expect, that doubtful debt. But now the only difference between LGD and ECL is that LGD is normally in form of percentage. In fact, when they happen, you say LGD is a percentage of the total, is a percentage. LGD is a percentage of the total exposure. A percentage of the total exposure at the time of default. At the time of default. Full stop. Hizo ndio vitu mpya zimekuja hapo. So down there you say ECL, when this one is the one which is most critical. In fact, I don't know, because I don't know, some of us we have not met, but in case we have some people who work in the bank, allow me not to ask who and who, but maybe there is high chances we do have in this class. Most of you have undergone training on this one here. This is a critical issue because actually it's a new issue in banking sector from 2019. How to compute the expected credit loss and what have you. So down there you say expected credit loss is equals to, when you want to get the total amount which should be considered as doubtful debt, is equals to the exposure at default times the probability of default times the loss given default. Like that. That is how you calculate the exposure. The expected credit losses. You take the amount which was exposed to the losses or default times that probability times the loss given default. Maybe the last one, which is not related to this issue here, is placements. Number 5. Placements. We cannot go without mentioning that. Placements. Placements. What happens by the banking? I don't know that banks want to in competition, but if they do have, it is at high level. Banks do borrow amongst themselves. KCB may lend National Bank, just for example. So KCB may lend LBK some money because huyu anastahili kulipa 1 billion, wako na payments to make. I want sufficient, I don't know to call it float or what. With reserves, let me call them those reserves. We don't have sufficient reserves to make those payments. They can borrow from another bank. Banks do borrow. That borrowing is called overnight. Overnight lending is always for a very short time because we can work on a trade. It is called overnight lending. Overnight lending is the placement. So placement represents interbank borrowing. When banks borrow among themselves, the amount borrowed is called placement. And look at your story here. So actually placement you can put in bracket overnight lending. That's another name. Overnight lending is the placement, which you write and say represents interbank borrowings. Interbank borrowings. What else in the bank can give us? an issue. Sioni. So for the first page note which we went through, get time muandike. Hakuna time sana ya kuwaste hapa. I know where issues will come ahead. So please, for now, get me out your past papers. Get me out your past papers. There's a question which normally tends to be very long. Check for me pilot paper. Pilot paper should be which sitting? Pilot ilikuwa December. I think it's December, yes. Pilot was December 2021. So I want you to check for me December 2021, question number 2. Then someone can tell us the page. Once you get it, tell us which page. Kindly. That question is always very long. I want us. I want to come out to the story. Lot of story. So December 2021, question 2, pilot. Remember December there are 2, there is pilot and the real setting. So check for pilot. Whoever gets it, my paper is not compatible with yours. So check for me which page. Whoever gets the page can throw it to us. Page 35, Brian. Na Brian, kwa nini umelogin na uko mara mbili, Brian? You are 2. Why?
Yes. Tuma internet inasumbua kwa laptop. So nimeweka pia kwa simu.
Haya. So page 35, kindly be there. Kindly be there. Be there. As you check for that, there is something examiner can bring na ileta shida. I don't know. I will say it. Well, utafute when utaandika because it's something I've seen somewhere. These people are making provision, the ECL, the expected credit loss. You know, expected credit loss we're supposed to capture as an expense in the financial statements. And I want you to give me your ears properly. ECL, you make it as a provision. Provision will be recognized as an expense. Expenses will reduce tax. The lower the tax, will reduce profits. The lower the profits, the lower the tax. Now, when you go to taxation, the allowable, there is what we call allowable expenses. Allowable expenses are those expenses which you are allowed to subtract for taxation purposes. So, when you go to tax, utaambiwa that the doubtful debts which you're supposed to utilize to reduce your tax are those which are specific, not general. Generally, just provision for everything. But for banks, these are specific because they know they gave loan to Juma, they gave loan to Brian, they gave loan to Hilda, Elizabeth was given a loan. So they know when they are making provision, the provisions are specific. They know this loan relates to this particular customer. So they are allowed to reduce the taxable profits with that provision. Then, doubtful debts is just 50-50. You don't know whether they will pay or they will not pay. Then later on, huyu mtu anakuja analipa. Wewe already KRA ulisha understate tax with that provision. So the question will be the impact of IFRS 9 on the financials. You can be told to explain the impact of IFRS 9 on banking institutions, and by extension, their effects on taxation of banking institutions. So the impact of IFRS 9 is that banks should make sufficient provision for doubtful debts, in brackets, the expected credit loss in the financial statements. Now, when it comes to tax, banks should make, as they make provision, ECL, they are also supposed to make provision for deferred tax. So in the financial statements, they also make provision for deferred tax. So that in the event, when you make the provision, you make provision of 50. Pia tax, najua hapo kuna effect inaweza kuwa 50. So you raise. So you raise that provision also with 30% tax, just in case of anything. So to mitigate against IFRS 9 expected credit loss on tax is to make provision for deferred tax in the financial statement. So that in the worst case scenario, these people pays, you still have sufficient amount in the company to make for those payments. Just in case examine analytic to come here. It's a new area actually, which we need to know. As I was making stories, kila mtu ako kwa hiyo page. So let's go there. I'm also there. Allow me to read. You are given the following list of balances for Star Bank Limited as at 31st of December 2020. Hey, hizo vitu sisi hatuwezi soma. Hizo vitu ni nyingi. Kama tusome. Cash and balances with Central Bank, financial assets at fair value through profit or loss, financial assets at fair value through other comprehensive income. For early morning, we have not covered the financial instruments. When you're talking evening, the honor of financial instruments. So as per IFRS number 9, currently financial instruments are the bonds, the debentures, and loan notes, and what have you. We only classify them into two categories, unlike those old standards, IS 37 and 39, where we were being given other classifications of health to maturity and the rest. Those ones are no longer there. We only classify financial instruments into two categories. That is financial assets at fair value through profit or loss. Those are short term. Remember, profit and loss is only prepared for 1 year. So if they are financial assets which are classified through P&L, it means they are short term. They are only for that particular financial period. Through other comprehensive income, those are long-term financial assets. That is what you need to know, how to separate them. Financial assets through P&L are short-term. Short-term means if they gain value, you take to P&L because it's for 1 year. In the balance sheet, you take them under current assets. This other one are through comprehensive, they are long-term. If they lose value, you don't take to P&L. You recognize them as other comprehensive. In the balance sheet, you recognize them as non-current. Installment tax paid, due from other banks, loans and advances to customers, expected credit loss allowance. So good. Now, when we talk of expected credit loss allowance, you understand. If you don't want to stress your head with a lot of stories, you just know expected credit loss allowance is just doubtful debts. If you don't want to think a lot of stuff. property and equipment, intangible assets, interest income, interest expense, fees and commission income, fees and commission expense, income from forex trading, other income, impairment, loss on loans, staff costs, other operating costs due to other banks, deposit from customers, other borrowings, other liabilities, net pension liability, deferred tax, share capital, fair value reserve. Fair value reserve may be just, could explain to you. Fair value is always the market value. Market value, there is always that fluctuation, kila siku, price chini, juu, and all that. So you just have a reserve in case. Ile mnasemanga tumetenga. Unatenga certain amount, in case there is fluctuation, you have sufficient amount to cover the loss in market value. Then retained earnings. Additional information, accrued interest, I think they were supposed to write accrued interest income and expense at shillings 240 million and 100 million respectively. So interest, income, and expense, okay. Those are just accruals. For the purpose of estimating the expected credit loss on loans and advances at the end of the year, the following aggregated data is available. So they wanted to estimate the expected credit loss for that year. So they gave us the information, the loan. So they had loan categories. There was loan category 1 to loan category number 4. Then we have exposure at default, EAD. We had the probability of default. Then we had loss given default. So without going to read a lot of stories, tunaweza malizia hii haraka haraka. Let's get the ECL, because this data was to help us estimate the ECL. So you see the exposure at default, that is the total amount which was outstanding at the time when these people were suspecting watu wanaweza kosa kulipa. That is the exposure at default. Probability is the credit rating. Credit rating kama hii ya CRB. What is the probability huyu mtu anaweza kosa hata kulipa loan? The loss given default, we discussed them. So let's calculate ECL from that data very fast. Then we go to the second one. So we can just call it working 1. So working number 1, we want to estimate the expected credit loss. We want to estimate the expected credit loss. And remember, to get the expected credit loss, you will take the exposure at default times the probability at default times the loss given default. You multiply those 3. So you can say here, loan category. So loan category 1, 2, 3, up to 4. Exposure at default. That is 22,300. If we have to be very thorough, you have to be very thorough. It's very serious. 54,800. You have to understand these things first. And once you understand the theory parts, ingine is like itakuwa rahisi. 65,700. 65,700. 59,500. Then probability at default 0.05, because they are in percentage. This is 0.1 because it is 10%. This is 0.5. This is 100%. You know, probability of default means the probability this person might not pay. So ukienda CRB unapata wewe umpekea 100% probability of default. Huwezi pewa loan. Then loss given default is 100%, is 50%, is 30%, is 0.1, that is 10. So when you multiply the exposure at default times the probability of default times the loss given default, you will get the expected credit loss. So ladies and gentlemen, what I need from you is the total. Mimi sitazunguka to multiply. You multiply, bring them here, then give me that total. That is what I expect from you. Please do for me that favor. And let's check on speed. Usually, I think the last time we did it is a very long question. So we have to put it Kwarada. Ukipata answer, you don't shy away, unaweka, mwingine ata confirm. Vera is giving me 19,660. Someone to confirm Vera's answer. Two people won't get it wrong. Someone to confirm whatever Vera is giving up. Confirmed. Thank you. 19,660. So when you reason, when you reason from what I'm telling you, doubtful debts, then it will be very easy for you to understand. So this one is like the doubtful debt at the end of the year. As accountants, you have to appreciate. You have to appreciate that when it comes to doubtful debts, for P&L, we normally check increase or decrease. So there was expected credit loss in the trial balance. So that was the opening balance. So we need to check whether there is an increase or there is a decrease. If it is an increase, we expense. Decrease in doubtful debts we bring back as other income. So by extension down there, you write for me ECL accounts. ECL account. Balance brought down. Can you check in the schedule? How much was the opening balance? Someone? Pia muangalia ndio msiseme mimi naangalia nikiandika. How much was the opening? Opening in the, yeah, I think I can, it is 17,360. Yes, 17,360. Then at the end of the year, we have determined that now the doubtful debt is 19,660. So the provision has gone up. Increase in provision is an expense. So what will go to your profit account is the increase from 17 to 19. So here you say to P&L, profits for loss, your balancing figure. That is what we'll take to the profit account. How much? How much are we going to post in the P&L? $2,300. Thank you. In case the opening was not there, then the whole amount is the increase, 19,660, which you will take to P&L. But if the opening is there, you compare. So this is what we'll take to the profits. Thank you. Let's go to the next additional information. In fact, what I want us to do, let's analyze those notes as we move. Instead of reading all of them, then again we come back. So let's go to the next note we analyze as we move. So let's go to the next one, number 3. Let's go to number 3. Unless someone has an issue. Depreciation and amortization expense for the period amounted to 1,200 million. 200 million was amortization. That one has no problem. Depreciation plus amortization was 12. Amortization is 200, meaning depreciation is 1,000. So here it was okay. We have no issue with that. The following are the estimated fair value for the financial assets as at 31st December 2020. So financial assets at fair value through profit or loss. We have been given their closing figure, fair value through profits given. So what the examiner wants, you know, when you have opening values of assets and the closing values, check whether there is gain or loss. And what the examiner wants to check here critically is whether my students are aware that for the short term, if they gain or they lose value, that loss or gain goes to P&L. For other comprehensive, which are long-term, gain or loss goes to other comprehensive. What is this other comprehensive? Other comprehensive are those items which you capture in the financial, in the P&L after taxation. Any income or expense which you recognize in the P&L after tax, that is other comprehensive. And mostly it relates to hata tunazijuanga, revaluation is other comprehensive, actuarial gains is other comprehensive, foreign exchange is also other comprehensive. Mostly those three: foreign exchange, actuarial, and revaluation. So this other comprehensive is treated more or less of revaluation because it relates to long-term assets. So for that, there is no need of doing a working, but let's just do something small to save for our understanding purposes. So let's call it our working two. So up there, working two. Up there, working two. So working two, financial assets. Financial assets. So we can say here, financial assets through profit stock loss and other comprehensive income. There is no standardized way of doing it, but we can just adopt this for whatever. Then you can bring here balance brought down. You can talk of balance carried down. Gain stock loss. So that gain stock loss reported to, because that is what they are looking for, where to report the gain or loss in the fair value. That is what actually that is their main concern. So go to the schedule, you check those values. Whatever is in the schedule, unless otherwise, those are the opening balances. So check their opening balances. They are second and third from top. So this is 29,108. This is 62,720. Those are the opening. Then at the end of the year are the ones they are talking about in note number 4. 29,708, 63 to 30. So they have, in all cases, they have gained. Please give me those two gains. There is increase from 108 to 708, 62 to 63. So give me those two figures for the gains. Give me the two figures. Just use comma. This one, comma, then that one. I will note nafuatana hivyo. Joy, 6 and 510. 600, 510. So those gains, and now that is where the examiner is focusing. You know, profit and loss in account for that year. So when assets are classified through profit and loss, this 600, you take it to profit stock loss. That gain, it will go to P&L. So mtanikumbusha, tukifanya profit account, we'll bring this one as income. And P&L, when I say P&L, you bring it before tax. Any income or expense before tax is said to have been classified in the profit account. Any other which comes immediately after taxation, because you know, we normally tax after all income and expenses. So nothing should come, no income, no expense should come after tax. But should there be any income or expense immediately after tax, then that is called other comprehensive. So this one here goes to other comprehensive income. That one should be brought immediately after taxation. Correct. So that is what the examiner was looking for. And remember, in the balance sheet, I don't know whether this is very, yeah, it's good to know. In the balance sheet, of course, we know once we have remeasured the value of the assets, the remeasured value supersedes the initial value. So in the balance sheet, we'll take the closing balances, this one's here. In which case, this one is taken as current assets, this one here. The short term is taken as current assets, this one is taken as non-current. The beauty part with banking apply kujua current or non-current, zote zinaletwa pamoja, hivyo, all of them. But in liquidity sequence. So when you bring them on liquidity sequence, that's how bank prepare their asset, present their assets. On liquidity sequence, this one should come before this one here, because this is long term. You bring the one which is easily convertible into cash. This short term mostly are the money markets are short term, treasury bills are short term. So these ones are highly liquid. So this one should come in the balance sheet before this one here. Though cash never wakwangi very keen kuangalia ati gani nafaa ikuje before. Katika cash never unaleta hivyo, unasema kama tuko hivyo tu sote at once. Let's go to the next note 5. Hii note 5 inakaa iko na story mingi hapo. Let's go to note 5. So that by the time tunamaliza na hiyo note ingine, we are done with everything. We do presentation. So note 5. The bank operates a defined benefit pension plan. The bank operates a defined benefit pension plan, except for the contributions made, which is included in the staff costs. The following details have not been accounted for in the year. Was someone calling? No. Imeakisha taa. Nafaa kuizima. So they have not accounted for some issues here. Plan obligation, fair value of the plan assets, current service costs, benefits paid, interest rates cost estimated at 8%, expected return on plan assets at 6%. Other wanaweka question marks. Contributions made, plan obligation as at 31st December 2020, fair value of the plan assets on 31st December 2020. I know what they are testing, though this is in your syllabus. That note number 5 is a topic on its own, a complete topic called employee benefits. IS number 19, employee benefits. So what the standard requires, though it will be good, hapa taifanya tu as a working, tukisonga, but we shall go to that topic as a whole, so itakuwa rahisi. In fact, I can do it as the next topic, mkiwa fresh. So, I think watu hivi ni walikuwa naifanya ama walikuwa hapo, walikuwa wameanza, I don't know. So, what the standard requires, when an entity has a scheme, you need to evaluate what we call actuarial gain or actuarial loss, and you report them in the financial statements. When an entity, okay, wacha niwapeleke most hapo because we cover the topic early morning. Most of us, if not all, but I think majority, you have been approached by these people who sell insurance. Maybe some of us sell insurance, but it's still okay. Then they tell you, when you invest today, this amount, for 10 years, this is the amount you will get. You have seen that. Ukiwekelea hii kila mwaka for 10 years, you will get this amount. And if you are very keen, those people, they don't just do those things with the pen that mnakaa chini anakuandikia. No, they do have a sheet which has already been designed. Hata iko na hizo, anakuuliza how old are you? Wako na hizo miaka, na sijui nani aliwaambia watu wako 24 years and above ndio wanafaa kuinvest. Imeandikwa hiyo miaka 24, 25. Wanaifikishanga around hawapitangi 50, I think. Mpaka hapo. So if you invest at this age, this is blah blah, all those stories. So they have a customized list there with what you expect. That list, the person who comes is the salesperson. Whoever pre-designed that sheet is the person called actuary. Actuary, hiyo ndio kazi ya actuary. Sijui kama ni wao wanafanyanga actuarial science. So they are the people who do that computation. Mtu wa sales, yeye pia amekuwa tu trained kuelezea what will happen. So the actuary will estimate that at the end of year 1, if you contribute 20,000 in the scheme, wanakupea a lot of stories, do bonus, do nini, you will be able to get 24 at the end of year 1. Then at the end of year 1, you do what is called scheme reassessment. You find that they were saying 20, wewe ukienda kwa scheme ukapata ni 21. So the actuary expected 20, the actual outcome is 21. Then we talk of actuarial gain. That is the meaning of actuarial gain. The difference between the actual outcome and the actuary's anticipated value. What were they anticipating in the scheme based on their projection? What is the actual outcome in the scheme? So in case the actual outcome is higher than what the actuary anticipated in the scheme, we talk of actuarial gain. In the event it falls below the expectation, we talk of actuarial loss. So the examiner, what the examiner, anywhere you hear of contribution scheme in this class, the examiner always wants to check whether you are in a position to calculate the actuarial gain or actuarial loss. And it should be both on plan. Plan is the scheme. Scheme, you're where you are contributing. That is the plan of the scheme. So you should be able to calculate actuarial gain on the plan asset as well as plan obligation. Even in the bank, uki contribute, kila siku unasikianga ledger fee, sijui maintenance, sijui what, those are obligations. So as far as you are telling me, again, how much will you be deducting me there to service my scheme? So atakwambia year 1, maybe utakuwa na kama 50. Then you compare what is the actual obligation imechajiwa 60. So you report actuarial gain or actuarial loss. So whenever you hear of contribution schemes, as far as advanced financial reporting is concerned, you are supposed to check or determine actuarial gain or actuarial loss. Hakuna kitu kingine wanaangalia ni hiyo, and that is what you want to do. So let that one be our working number, I don't know, I think working number 3. We want to check, but I've said this is a topic which we are going to cover. So it will be easier for us. Here we're just passing as a work. That is what makes this question have a lot of stories. So our working 3, call it working 3-1. I want to determine whether there was actuarial gain or actuarial loss on the plan asset. Plan is the scheme. Kama una invest na Britam, for example, Jubilee, India, CIC, that CIC is the plan itself, the scheme where you are contributing. That's why we call it. So unajua kuna mtu ukisema plan asset, mtu anachoka. Hapana, plan asset is the amount you have invested in that scheme. So I want us to check actuarial gain stock loss on plan assets. Let's start with assets. You can even start with obligations, there is no problem. Let me check randomly, just randomly. Hilda, you randomly nimekufikia. Have you understood the concept of this issue of actuarial gain or loss, that concept. Why are we talking of actuarial gain or loss? From what I've explained, have you understood the reason behind it? Why we talk of actuarial gain or loss? Just the concept. I've just picked randomly. Yes. Maybe I can repeat once. The people who know this thing is normally projected in advance. When you contribute after 10 years, you will get this amount. Those amounts which are projected are always done by actuaries. But then for your information, and someone who works in insurance can bring us to speed, insurance companies, they always invest in actuaries than even accountants. And that is the truth. Because those people, they are the ones who knows how to come up with the estimates and the rest. So the actuary, amekuestimatea utapata 1 million at the end of this year, this period. When you assess, you check the scheme, amount is different. The variation between the expected and the actual outcome is the actuarial gain or actuarial loss. There we go. Shillings are in millions. Shillings are in millions. So we start from the beginning to the longer during the year. So we have fair value of plan assets brought down, the one in January. So in January, brought down, I'm seeing there 32. I hope we are together in that note 5. Then they tell you, invest kwa kitu haileti kitu. So lazima we expect to receive some returns. So there is expected return on plan asset. I hope you can see it down there as a question mark. So you need to earn expected returns. So expected return from 6%. So it is always 6% of the opening value at the beginning of the year. So 6% of 32. What should we report? How much are we reporting? We are reporting 192. Thank you. So I want you, okay. Maybe there are some of you sijaifunza before, but I can see majority nimefunza before, FR section 3 and the rest. Me, my way of teaching, unaona vile mnaendanga kuwatch, kuna watu wanaendanga kuwatch movie. Sijui hiyo movie mnaitanga sijui ni 7D ama 3D. Yaani unakaa hiyo ndani ya hiyo movie wewe mwenyewe. Unaona ukiwa hapo. That is how I want you to be. I want you to start hiyo kitu ya imaginations, venye tuna imagine venye mbinguni kuna kila mtu ako na nyumba yake ya gold and the rest. I don't want that imagination. I want you to be like you are the person. Tukifanya hizi vitu, one will make them real life because they are real life. So usijipe pressure. You be there as the accountant. Kwa pale kwa desk, you are the person doing this thing. Be inside that thing. Start with that cramming power. So you invested at the beginning of the year, our investment was at 32. Then lazima upate kwa minimum invest to get the returns. So the expected return 192. So your investment is increasing. Then during the year you must contribute. Contributions. Contributions you are making should increase your investment. So you earn contributions. Contributions, they made 25. They made 25. So you increase your investment in the scheme. In the event that you are paid benefits, or kulipa benefits inapunguza what you have in the scheme. So you net off. So less benefits paid. Ana inakwanga hivyo benefits paid. That's how we do it. So benefits paid, I can see 40. And also students, this thing is not real. All this real hapa peke yake ni 32. That was the balance opening. Hizi zingine inapoka projection. Huyo mtu anafanya mapema at beginning. This year tutakupatia 6%, and you know as per the agreement you're supposed to contribute 25. This year you will be paid 40. So all this was the projected amount. So this is the actuary's expected value. So that is what they actually expected to be in the scheme. Please give me that figure. Opening was this, you will get this, contribute this, we pay you benefits, we reduce what you have. So how much should this person be having in the scheme? Actually, that was the anticipated value. How much? Joy, 33, and Butch, 33.77. So actually, anticipated that value in the scheme. Skip one line. You take for me the fair value of plan assets carried down, the closing. So closing is the real figure now. Closing is the real, I think we had them. If we go to the schedule, how many schedule I think. How much people schedule? Am I in the same notes? Just a minute. Oh, in the same notes. In the same note 5. Check note 5. Yes, because you balance hiyo schedule na 5 opening. In the same note 5, uko chini kabisa the last. Fair value of plan asset on 31st December, 34.19. 34.19. So this is the actual outcome. All these ones were projections by the actuary. This is what they actually expected to be in the scheme. The actual outcome is 34.19. Your balancing figure is called actuarial gain or actuarial loss. From your own observation, are we reporting a loss or a gain, and by how much? That is, yes. Gain, loss, and how much? Actuarial gain or actuarial loss, and by how much? People are getting gain of 42, yes. We only expected 33. We got 34. So this is actuarial gain. And that is the BF. BF is the balancing figure of 42. Correct. Now, when you gain on employees, blah, 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 that is not an income. Kwani iwe biashara yako ni kukuwa na employees waweke kwa scheme, you gain, then you bring that as income. Hakuna mtu atakubali, because remember, income will attract tax. So hakuna mtu ataweka employees ati wakigain wanaleta hapa then they tax. Hakuna kitu kama hiyo. So always actuarial gain or loss goes to other comprehensive. I mentioned and I will still mention. Other comprehensive is any income, is any expense after tax. So this one goes to other comprehensive. Kama ile sister yake ingine ile tuliona huko. Haya, the same time, we don't only talk of plan assets. There is always obligations at the same time. So the same assessment we have done for assets, let's also do it to the obligations. So down there, 3 Roman 2, me, I want to delete this one. So 3.2, right there, actuarial gain stock loss on plan obligations. Allow me to delete this. I hope everyone is there. Plan obligations. All right. So we start. Remember, obligations is not measured in fair value, present value. Why present value? Obligation is paid in the future, but we are analyzing today. So we always talk of present value because of the discounting factor. But you don't discount, you just, okay, liabilities are measured in present value. Assets are measured on their fair value. That is what you need to know. So present value of plan obligations. On plan obligations, it goes down. So how much? How much note 5? Plan obligations 4250. So tukifungua scheme, hiyo mwaka tu tukifungua scheme, walikuwa na deni. For scheme, they had a debt of 4250. Then there is a caution. Should you fail to pay, tutakucharge interest. The liability will earn interest. Kama kuna banki ingine, should I mention? There's a bank, I can't recall. Izile mnafunguanga for fun. Tulifungua for fun in 2007. Ile for fun tu ijulikane uko na bank account. Baka karibu unaandika kwa CV the bank you have. Kumbe si kujua ukifungua CV ni current account and CV what. If you don't operate, they attract some costs. Well, it came to follow me now back in 2015. And I had to clear that amount and close the account. So those are the obligations. So plan obligation was 4250. Failure to service or to pay that obligation, we charge you. So you add interest charge. Interest charge. They said they will charge us interest rate cost of 8%. I hope you can see the 8% there. They will charge 8% if you fail to service. So how much is that? 8% of 4250. $340. There is always what we call current service cost. Current service cost to maintain that scheme, you have to add it. It's part of your obligations. So current service cost, you add it as part of your liability. We will discuss it into details to figure out your topic. So current service cost was 460. So you are charged for that. Then the benefits paid, it cuts across. When you are paid benefits, it is assumed that your obligation in the scheme is charged proportionately to what you have. Someone with 1 billion in the account, cost of maintaining that account, and someone with savings of 10,000, they are different. So your scheme obligation will reduce proportionately with the amount you have been paid. So when you pay the amount, you credit the asset to reduce the asset, which we have done. We subtracted it from investment. So you reduce the assets, also you debit the obligation account. So benefits paid cuts across both assets and obligations at the same time. So you net it off from the assets, reduce your assets. Also obligations, the assessment is always based on what you have. So what you have been paid also reduce your obligations in the same amount. So less benefits paid. Benefits paid was 40. Not even was, will be. Become in real time. Actually, using these estimations, by the way, for your information. So this is what the actuary expected in the scheme. The actuary's expected value. How much did the actuary expect in the scheme? Project for me that, bio. I think after that, ni tunamalizia kufanya swali. Joy, 50-10. 50-10. Skip one line. We check the actual outcome vis-a-vis now the expectation. So present value of plan obligation carried down. How much was it? In note 5, just check a couple of 5, second last, 5192. 5192. Are we reporting a gain or a loss, and by how much? So we are talking of actuarial gain or actuarial loss, and by how much? Well, people are differing here. Joy, gain 182. Hilda, loss of 182. So what I know now, 182 is the answer, but now which is which? Loss, gain, Jacinta? Loss. So maybe wale wako wamekawa na watu wamekawa hapo ndio different na kujia, but I can explain. I will not explain by by explaining, by giving illustration, mpaka anze kuja kwa mdomo yako. Munaenda kulipa exam cast name. But then when is the deadline for paying exams? Kuna watu wajuangi wanashtuka ikiisha. When is the deadline for paying exams? Food imekuja kwa kisha yangu. When are you supposed to pay for exams? Massive 182 again. Naangalia tu sahi. Hiyo mambo exam ndio tunataka explain nayo hii. Mwende 3rd November. At least you have been informed. 3rd November is the deadline for paying for exams. For exams. Sawa. You will not bring a lot of stories. Now, munaenda kulipa exam cast name. So wacha nisonge na nani? Anybody. The amount you're supposed to pay to cast name is 5,000. Okay, what you expected, yenye umebeba 5,000 because this is what you expected to pay. So umebeba 5,000 naenda cast name. Kulipa. Kufika, si kwa bank, umeenda kwa cast name kwenyewe kuqueue. Ulibeba 5,000. Kufika hapo, unapata wale wasichana wanapanga hapo kwa reception. Ni reception ama hapo kwa counter. Unampea 5,000, anakuuliza which units are you booking, blah blah blah. Anakuambia ni 5192. So madam ama kijana top up another 192. So when you are topping them up, you have gained or you have lost. I think that one answers our question. Have you lost or you have gained? Umebeba 5,000 alafu mtu anakuambia uongeze. You have lost, you have gained. Yes, now mmejibu vizuri, you have lost. So increase in obligation. When a liability goes up, you have lost. So that is actuarial loss. It is the opposite of assets. Assets, increase in assets is a gain. Increase in obligation is a loss. So we lost 182. Thank you. Now, check here. This is the same scheme. This is the same plan. You have on assets we gained. You have gained on your investment, you have lost on your obligation side. The standard again requires you need to get the net. You're supposed to get the net position. So you will come here and tell me net actuarial loss. It will be a loss because we have lost 182. I remember we gained 42. Yes, it was 42. We gained 42 on the assets, we've lost on obligation 182. So the net loss, we are talking of 140. I'm subtracting the gain because this is a loss. So I'm reducing the loss because I have a gain. And this one here will go to net actuarial loss. This one should go to other comprehensive income. Your number loss, we don't take it to P&L, it goes to other comprehensive. That is one. 2, interest. So this one here. When you check the expected return, you know expected return is interest income. So you have invested, you are expecting to get some interest on top. So on the assets, assets, 6%, it was 6%. How much was it in value? 6% of that amount, it came to how much? I want to know whether we have interest income or interest expense. How much was it? The 6% of the assets up there. It was 192, thank you. So on the assets, we expected interest income of 192. On obligation, we have been charged 340. So we are talking of net interest expense. Net interest expense of 340. We have an expense of 340 with an income of 192. So we are reporting how much? 340 minus 192. It could be 148. So here we are reporting 148 to P&L. Interest goes to profit account. It is not other comprehensive. Finally, check the last two. Check the last two in note 5. This question is as long as it is. We don't have any shortcut. The last two in note 5, we have plan obligation in December, fair value plan assets December. Obligation is 51, asset is 34. So hakuna haja tujidanganye. It's the same scheme pale. Sema wewe the account manager in this company. Obligation yao is 51. What they have saved is 34, net of the position. You cannot recognize the two in the balance sheet. Net of the two, you report one. So we'll talk of net pension liability. Liability imekuwa mingi. 5192 minus the available assets, 3419. So we are reporting how much? 1773. So that one will go to the liabilities in the balance sheet. Ama unataka kuandika to SFP, statement of financial position. That is where we'll throw it. So you don't recognize the two. If you come examine and mark wrong, but accounting, we can't do accounting like that. In the same scheme, I can liability this side, I can asset, net of the position. Well, that one took our time, but thank you. Let's wind up with note 6. After note 6, we do presentation, then we are done with that question. So note number 6, the net taxable temporary differences as at the end of the period are estimated at 9,300 million. This excludes any temporary differences from note 4 and 5. That's not even our concern. The tax rate is 30%. Meanwhile, the current tax for the year is estimated at 2,800. No issue. No issue. No issue. Now, what the examiner wants is for us to, any moment you hear of temporary differences, permanent differences, that person anakupeleka kwa nyumba ya deferred tax. Any moment you hear of temporary, permanent differences, unapelekwa kwa deferred tax. When you take tax rate times temporary differences, though this one we're going to cover in deferred tax, I don't know whether to move a little bit to help you understand. Yes, I can. But it is necessary. Yes, kidogo tu. Accountants in Kenya, let me be on Kenyan jurisdiction. In Kenya, we close books on 31st December. Most entities, though not all. Most companies close their books on 31st December. Who is closing the books? Accountant. Accountant akifunga vitabu, one of the expenses anafunga hapo ni depreciation. Hold that. Taxman, represented by Mr. Auditor, anakujanga the following year. Remember, we normally file our returns on or before 30th of June next year. So taxman atakuja baadaye. Taxman akikuja, wanakujanga na one word, disallowable. I hope you remember those stories. So depreciation will not be allowed for tax purposes. So they start adding back. So there will be variation. But that variation in allowable and disallowable expenses, which will be brought by the tax person, the auditor here in quotes, it is temporary because the rectification in about 6 months to period to rectify that. That is why we call them temporary. I will expound much when we are doing the topic. So here, what the examiner wants is you to calculate deferred tax, nothing else. Any moment you have temporary, permanent differences in financial reporting, thinking begins after you have tried to calculate deferred tax. So that is our last working. That is our last working before presentation. Very serious question here. So right there, deferred tax account. Deferred tax account. Have there deferred tax accounts. That is our last working now before presentation. So deferred tax, can you check for me how much was the opening balance? Opening balances are the ones appearing in the schedule. How much was the opening? $2,400, Joy? Ilikuwa. Defer 1, 2, 3, 4. 1, 2, 3, 4. Yes, it is 2,400. If you check the schedule, you'll be able to see 24. At the end of the year, note number 6, the total estimated was 93. So balance carried down. Hizo mtu wanasema note 3 and 4 hakuna mambo ya tax hapo. Take 9,300, you multiply by the tax rates. When you take temporary, you subject to tax rate, what you get is deferred tax. So when ukisikia tu temporary, chukua tax rate. Chapa nayo. Corporate tax, naweka nayo. But hii niwaulize, no. Being in Kenya as individual is worse than you being a company. So, because companies are being taxed, corporate tax 30%. Hii yetu ya individual hata ina exceed 30% on salaries. So you should be an institute instead of individual. This times this, what do you get? People are getting 27.90. So the increase is what we take to the profit account. It has increased from 24 to 27. So that is what we take to P&L as expense. How much? How much? 20, that is 390. Yes, that is 390. You'll remind me when the time comes. Correct, we are done. We are done with all the notes. Let's go to required. Prepare the following financial statements. The statement of profit or loss for the year ended 31st December 2020. The statement of financial position. So there we go. Let's start with the profit account. Let's start now presentation. They are called Starbank Limited. I want to give them presentation here. For the year ended, year is ending when? 31st December 2020. So shillings are in millions. Let's maintain 2 columns. Yeah, you should be ready now. Now, main source of income, the main source of income for these banks is the interest. So you write here, interest income interest income, interest income. So ukifanya bank, unaanzianga hapo. You start with the interest income. That is the format dictated by the IS number 30 of banking. So interest income, now let's check on our schedule. Let's check on our schedule. Top down, another top down to avoid omission. I'm seeing interest, interest income actually. Interest income. I'm seeing, you are seeing how much? How much are you seeing? So that I check whether it is the same with what I'm seeing. I'm seeing 29,061. Yes. So it is 29,061, yes. However, if you check additional information number 1, check additional information number 1, accrued interest income. We all know at this level now, accrued income should be added. There are those income which we ought to have received, but we never received. So you add the 240. This is the accrued. So add the 2, give me the figure. Figures in your view. I want us to finish exactly on time. Usually mostly aishangi. All right, so good. 29, year 1. 29? Year 1, good. 29, year 1. Then there was no any interest income. So what you need to bring, so you need to tell us the interest expense. There is no any other interest income. Otherwise, any interest you could have stated them here. We don't have. So interest in that order. Interest expense. So interest expense, they have just also mentioned it like that. So interest expense. Also there was accrued. So that one is 7069 plus accrued in note 1, 100. So that one would be 7169. So the net interest income, and that is the order. Net interest income subtract net interest income is how much? The difference. 22,132. Thank you. Then there are some other income which were not interest. That is how this format goes. So you bring them here as none. Non-interest income. Those income which had nothing to do with interest. Look for them top down as well. Top down. So top down. Which one are you seeing? Fees. There is fees and commissions income. Fees and commissions income. That one I can see 6711 there. Fees and commission expense, no. Income from forex trading. So income from forex trading. Forex trading. Income from forex trading. 4045. Please don't copy mine. Make sure you are seeing. I can also pick a wrong figure. Expenses we calculate from note 5. Wait, kidogo. I'm seeing Hilda. What about the nets? Kidogo hapo. Jacinta is talking of the board. Jacinta, maybe I can. Let me switch off the lights. Whether it is better that way. I hope it's somehow better. Hilda, what about the net interest? Net interest expense. We calculated in note 5. Note 5. Oh yeah, there was the net. Yes. The net interest. I want to bring it as other none. Actually, it should be there. I'm coming back there. The 148, yes, I'll bring it. Let's hold it now. So income from forex, 4045. Let's take all other income. It will not bring a very big issue there. There was check notes number, which note, students? Note 4. Pale kwa fair value. The fair value changes on the financial assets. There was gain on fair value of financial assets through profit and loss. In full. Financial assets through P&L. Comprehensive, comprehensive will come as other comprehensive. So gain on financial assets, gain on fair value of financial assets. Gain on fair value of financial assets through P&L. 600 or something. Can you check for me? Is an analysis we did somewhere there. How much was it? I'm seeing 600. Yes, I remember it was around 600. All right. Now, before we add, Hilda is reminding me something in note 5. There was 148. Was it 148 or 140? Hilda, whichever it was. Note 5, where we did note 5, the net interest expense from the plan obligation, but you can net off. We netted off the entire thing. After we netted off, did we not get 192? Hilda, was it 148? Please confirm the net interest expense. Please check for me. Our working 5. It should be working 3 after Roman 2. After Roman 2, working 3. Yes. After working 3, it should be 192. Better as confirmed, Hilda. $340 minus 192, which now brings 148. Okay, thank you. So that one was supposed to be here, upper for interest. I think it was an oversight on my side. So we can still bring it before we add. So just fix it here. Thank you. 148. So that 148 is interest. You call it interest. Pension interest. whichever name you call it. Pension interest 148. So net interest income will change. So 29 to your 1 minus the 2. The gain was, so first it was 600. Oh yeah, this one here, it was 600, not 6,000. 600. So 29 minus this minus that, what do you get? Then we adjust for this other one. I think somebody gave me 6,000. $21,984. 21,984. I add these three, then we get the total. Total income. Total income. Total income will be how much? Total income. $33,340. 33,340. Bring for me now non-interest expenses. Those expenses which have nothing to do with interest, in that order. So by the way, that format is always divided into 4. Easy. Usikuje na format ingine. This is how it's supposed to be presented. Interest income, interest expense, non-interest income, non-interest expenses, in that order. So non-interest expenses, top down to avoid omission. There was fees and commissions expenses. There is fees and commission expenses. This was how much? It is 1086. Bring it to the first column. First column, 1086. Okay. But there is 32 somewhere. Hey, is someone seeing 32? There is 32 we are omitting. Though Afra, here, before total income, there is other income. Hapo karibu na hii fees. There is other income of 32. Please confirm you are seeing 32 somewhere. Are you seeing it? There is 32 somewhere imejificha as other income. I hope you have seen it. So I just adjust this to 32. It will be 70. 33 will be like that. Then we proceed to mejificha jificha. Fees and commission 1086. Then downwards, income, other income, impairment. There is impairment loss on loans. Impairment loss on loans, 3871. Impairment on loans is 3871. We proceed downwards. Staff costs. There is staff costs. I hope siwachi watu wengine nyuma. So staff cost. Staff cost, where is staff cost? Staff cost is 11,184. But there is something I heard about staff cost, which we need to check. check note number 5. Where note 5 started, please check note 5. They said the bank operates a defined benefit pension plan, except for the contributions made, which is included in the staff cost. The following details have not been accounted for in the year. You know, we normally assume, unless well, we want to top up, we deduct from employees. Then we save, unless there is like this one for Kenya where you employee want to contribute. So for the staff cost, I will net off. I will try to net off the staff cost amount contributed is how much? Contributions made, check up on 5. The contributions which have been made, 25. The contributions you are making for employee benefits, sometimes it is always assumed to be deducted from, because like in Kenya, check NSSF, employer atawa 6%, mwingine 6%, both mnakatwa. So if we leave the whole amount of staff costs, that 25, which they are included there, the contribution they made to the pension scheme to be part of staff costs, then we'll be lying to ourselves because other staff when you want to contribute. So I think the examiner was to come out clear there. So I'll take the 11,184, I subtract that 25. See, staff here want to contribute. And furthermore, by the way, when you are contributing those people, you should not, after you can limit, you should not bring them as part of your staff costs. You only benefits much contribute for the work they have been doing for the company. How much are we reporting? How much are you reporting? If we net off, it will be 11 something. 11,159. In the first column, we proceed other operating costs. Operating costs, we have 47.94. Due to other banks, no. Deposits, no. Borrowings, no. Liabilities, no. Net pension, no. Deferred, no. Share capital, no. Fair value reserve, no. Returned, no. To the notes, note 1 we did. Note 2 was about ECL. Yes. Expected credit loss. How much did we get? Can you check? We came up with the table, ECL table, the increase in the expected credit loss. I think it was our working number 1. How much was the increase in ECL? Vera, 2,300. I'm told we got 2,300. We proceed. Note 3, depreciation. So there is depreciation. And also there was amortization. So depreciation and amortization was 12. 200 was amortization. So depreciation is 1,000. Total was 12, but amortization is 2. So depreciation goes with 1. I hope that is clear to us. Note 4, there is no problem. Note 5, I don't see anything we are supposed to bring there. I don't see any. I don't see any, unless, but let me check. Plan fair value. Current service cost, yes. Current service cost is an expense. So current service cost. We have a current service cost of 460. That one you need to bring there. Benefits, interest, reshuffle, expected contribution. The rest are done. Number 6 is tax. We don't need tax at this stage. So unless there is something you are seeing, we have omitted, you can bring it up. Otherwise, I think we have captured almost everything. So can you add for me non-interest expenses? Unless there is something you feel we have left outside, we can bring it up. How much? 19,913, Jacinta. Jacinta is getting 19,913. Can you confirm? One person can confirm Jacinta's answer. Then we proceed. Jacinta, why are people quiet on this answer of yours? Aya, kila mtu basi apeane yake. Joy is getting 24. So someone again now has to break between Joy and Vera is also getting 24, 870. Then Jacinta, I will check again. Ama ujaa, this is the huku the kwanza. Jacinta, have you left these two? People are getting 24, 870. 24, 870. Correct. Therefore, yes, that's the total expenses. Adding 10 this, but I can also tell this plus this is 43. 43 plus 4, hiyo peke yake shafika 9. 9 plus 11 is 20. So Jacinta is because of the addis, so it must be up. So profit before tax, you take the 33,372 minus that one there. What will be our profit before taxation? $85,02. 85,02. Then you less tax, less income tax. So income tax, current, we had current tax, and we had deferred. We had deferred tax. We had the current and deferred taxes. Correct. So current tax, check note 6. Check note 6. The very last bit of note 6, current tax was 28. Current tax was 28. Deferred tax, the increase, what did we get? Check deferred tax account, the one we came up with. In the deferred tax account, how much was the increase in deferred tax? How much was the increase in deferred tax? 390. So this was 390. So that will be 3190. You less. You less. Therefore, profit after tax, PAT, will be how much? 8502 minus 3190. How much do you report? You are reporting 5312. 5312. Then you bring other comprehensive income. Other comprehensive income. So other comprehensive income, there was fair value gain on financial assets Fair value gain on financial assets through other comprehensive income. OCI, tunakuwa tunatumia sana in so many questions. OCI stands for other comprehensive income. How much was it? Pale mlitoa ile 600. How much was it? Was it for 10 or something? 10, 510. So this was 510. Then there was net actuarial. There was net actuarial loss. Actuarial loss is other comprehensive. How much was it? The net actuarial loss. We got how much? $140. Thank you. So that one is less. Therefore, we are done with that. Total comprehensive income is how much? Total comprehensive. There's a lot of reflection there, but I hope we are together. Total comprehensive, you take 5312 plus 510 minus 140. What do you get? 56. You get 5682. Full stop. Who has a question on that? Who has a question before we go to the balance sheet? Aye. Let's go then to the statement of financial position. Let's go to the statement of financial position. So Starbank Limited. Kumaliza hiyo class imeisha hiyo. So Starbank Limited statement of financial position as at 31st December 2020. So we can start. So I said, for not me saying, the standard is the one saying. Here, assets, you bring them on liquidity sequence. You don't have to say non-current assets, then we go to current. For bank, we don't do that. You just give us assets. And you can just try, unaweza jaribu kufanya hiyo liquidity, lakini customer wa focus sana. What you can do to at least to be relevant in exam, try to start with the cash, na huko chini umalize na PPE. Hivyo. Hizi zingine hapo katikati unaweza leta hivyo. But you can try if you so wish to. So let's start with cash and balances with central bank. Cash and balances with central bank. So in central bank we are having 23,531. Financial assets, yes. Financial assets at fair value through P&L. Those are short term, is okay. Those are treasury bills, the money markets and the rest, those are short term. 29,108. Financial assets at hizo ni long term. Hizo wacha yuko ni long ingoje kidogo. Then due from other banks. Due from other banks. Due from other banks 6572. Don't copy my figures. Make sure you're seeing them because I can also write something is not correct. Due from other banks. Loans and advances to customers. Loans and advances to customers. Please don't post that loan. I want to tell you something. Don't post on the loans. So, first of all, how much is the loans to customers, which you are saying? How much is the loans to customers? The figure you can see, I want to relate it somehow. John, 202,300. Yeah, it is 202,300. Can you subject it to note number 2? Pale tulikuwa tumepewa loan categories. The total of loan categories, check the loan categories. The total of loan categories, that is the exposure at default. Exposure at default is the amount which was there, which was, at the time we were assessing the risk, the amount which was there, 202,300. So it is the same amount which is outstanding as the loan. On that amount, there is expected credit loss we calculated on that amount. So how much was it? The total expected credit loss, not the increase, the total you got from that schedule. You are working one. How much was the expected credit loss? The total. You got 19,660. So you need to reduce out of this 202,300. We don't expect. There is doubtful of this one here. 19,660. So you need to subtract. Yeah, that is the truth. See the provision for doubtful debt, so you subtract out of that. So write in your books, this one is ECL, the expected credit loss. How much do you get? How much do you get? 182,640. 182,640. Very good. We proceed. After loans, property, what ingoje, intangible, ingoje kidogo. There is note number 1. Please check for me note 1. Check for me note 1. Accrued interest income. See, that is interest receivable. So accrued interest income. Accruals are always short term. Accrued interest income is 240. That one will get its way there. We can bring these others just in case of anything you need to. So these others are not very liquid. But in exam, I don't advocate students disumbuke kuangalia liquidity. If you wish, one time I kusumbui sawa. But bora ukianzia kwa na cash, unimalizia na PPE huko chini. I have no problem. So there was financial assets at fair value through OCI, other comprehensive. And this figure is wrong, eh? I hope. This one. It should be 29,7 or 8, not 1 or 8. Check note number 4. We take the closing, the revalued figure. So change 1 to be 7. It's supposed to be 7 or 8. We took the opening. So the long term is 63 in note 4, 63 to 30. 63 to 30. Good. Then there was what, students? Intangible assets Intangible assets, where are they? What is the figure? I saw it somewhere. So I saw it somewhere near PPE. Yes, near PPE. It is 1078. Yes, it is 1078. However, when you check note number 3, check note 3, additional information number 3. In note number 3, they are saying depreciation and amortization is 12. 200 is amortization. What are we amortizing? So those intangible assets. So reduce this with 200, then depreciation that all for PPE. So this is amortization, the 200. So 1078 minus 200, you're likely to get how much? $878. 878. Students, is there anything maybe we have left? Property, plant, and equipment. So property, plant, and equipment, 5752 minus amortization, depreciation of 1, 4762. Correct. So total assets, if you see something, you bring it up, but I don't think if there is. Total assets. Give me the answer. Honorable ladies and gentlemen. Bali hakuna swali lingine ya banking itakuwa mbaya kama hii. Si afadhali uanze where should we always start from? Ni vizuri kuanzia faraja ukielekea kwa dhiki ama dhiki ukielekea kwa faraja. Meanwhile, Joy Mwende, people are reporting 311, 561. So 311, 561. Unless there is alternative, I think we are within time. Class is to end at 8:45. It is 8:31. So we are much okay. Actually, it's good. We can do in one lesson because of those workings. It was a lot of workings. So hii tunamaliza, it means we are good. Alright, so let's go to equity and liabilities. Equity and liabilities. The ordinary share capital, share premium, retained earnings, any reserve in this world is equity unless otherwise. So we start with share capital. Share capital is in the schedule down there, 27, I hope it is, 2716 to the far end, 2716. I hope you can see that. Follow down there with fair value reserve. Fair value reserve. Fair value reserve, I'm seeing 429. Retained earnings. Retained earnings. Retained earnings. Retained earnings, the one which we have been given, 17,422 plus. Hebu nipatie profit for the year. Ile tumepata kwa P&L not total comprehensive, the PAT. Comprehensive should come here separately as a separate component of equity. So give me the PAT, profit after tax, in our P&L. Joy, 5312. 5312 minus, in case there were no dividends, mostly, this plus PAT, this is PAT, profit after tax, minus dividends, in case dividends were there. What do you get? What are you getting? 1722 plus that. Uh-huh. 22,374. Hilda, interchange, people are giving 22,374, going back 22,734. Which is which? 22? 734. Okay. 734. 22, 734. Good. Other comprehensive. Other comprehensive. There was 510. There was, you need to bring one figure. There was 510. I remember there was a loss of 140. There were two of them. There was the 510 and there was the 140. Giving us 510 minus 140 should be how much? How much? 370. That should be 370. I don't see anything for equity. Can you add for me the total? Yeah, I don't see anything else. Unless mtu anaona kitu. Total will be how much? How much? Joyce getting 26,249. Confirmation bio. I always want at least more than a confirm, then 26,249. 26,249. Now, then just right now, liabilities. 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 I want us to kill those liabilities. So even liabilities, you should bring them on liquidity sequence. Look at them here. So from top down. From top down, there is which one is here? Is due to other banks. I hope you can see it. Due to other banks. Due to other banks. Due to other banks. Okay, how much is this? It is 5308. Please check. First column. Check 5308. due to other banks. Deposits from customers. Deposits from customers. From customers, I'm seeing 259, 346. 259, 346. Other borrowings. Other borrowings. Other borrowings. I'm seeing there 5096, 5096. Then other liabilities. Other liabilities. I'm seeing there 10,313. Then net pension liability. Check working, I don't know if it was which working 3.2, hapo chini ya working 3.2. There is a figure we got. We got 17, I'm told 1773. 1773. 1773. Then deferred tax. Deferred tax. And we check for me, deferred tax account, the balance at the end, the closing balance for deferred tax. Check for me, it was how much? Deferred tax, I'm told closing was 2790. 2790. 2790. Current tax. Current tax. Check note 6. Check note 6. Note 6, current tax was 28. However, Mr. Examiner said in the schedule, kuna mali number 4 from top. 1, 2, 3, 4. Installment tax paid. Once you pay, it ceases to be a liability. So you subtract. But in the P&L, you recognize the whole amount. You know, accounting is based on accruals. Accruals means you recognize whether paid or not. So the total was 28. For P&L, we don't want to know whether paid or not. We recognize everything. But for liability purposes, you subtract the part which has been paid, 2214. 2214. How much do you get? 28 minus 2214. Mm-hmm. 586. 586. Then, accrued. There was accrued interest. Check note 1. Accrued interest. Note 1. There was accrued interest of 100. Unless if you give it. Can you add for me those things? I don't think if there is any other thing. Can you try to add so that we can be able to see? Add for me all the liabilities. Joyce getting 285, 312. Can somebody confirm? Confirmed. 285, 285, 312. I don't have a space, but can you confirm for me, just for accuracy purposes, whether it is balancing with our total assets? Because of course, when you're accurate, it should balance. When you add 26, 249 plus this total, you call it total equity and liabilities down there. The name, total equity and liabilities. Confirm whether it is balancing with our total assets. If yes, then that question ends there. Brian says yes and confirmed. So that is okay. So balancing means 311, 561. One more question. Oh, me siwezi fanya swali moja kwa topic. That one is me. So the main thing is understanding. Kuna syllabus tutamaliza. Hata kama itabidi tunaingia class saa 8 ya usiku. Syllabus will be over, but we have to try at least quality. So actually you only have 2 questions in this past paper. In the entire past paper, you only have this, and I've seen April 2022. April 2022. I want you to attend this for our next class. 2022, question 4. Lakini hiyo swali kuna kitu moja ilikuwa ina miss. There's something which was missing in the schedule. I don't know what was. I'll check. There is one thing, I think something new from bank was not from Casnem, but whoever was compressing for us, kama kuna kitu alikata. So, but that cannot buy you from attempting. It's just one entry which was missing. I can't recall ilikuwa gani, but I'll look for it for the next class. So you can try, by the way. Kama additional information inakusumbua, there are only 3 additional information. Wewe enda na hiyo format so that you can check whether you know the format, unaziweka hapo, then all shall be well. Now, announcement. The announcement is this is question 4. Question 4. This one, April 2022, question 4. The announcement, this is the first week of October. Yes. So next weekend is the second week. So after next weekend, we shall come back to the negotiation table with you. We have to negotiate. I'm giving you only next weekend. After next weekend, the other week, the 3rd week of October, I need to give you another extra remedial class from this one. I know how this thing is wide. I know. So we will have to agree on what time we are fixing. Apart from this one, we need to have another extra class. Kuna topic hapo inaitwa Mr. Group is very wide. So we'll make up one extra. Start thinking. Ndio watu wakianza kuchangia hiyo siku, usiseme mwalimu give us time to think. So think after our next Sunday class for winning, a time like this tukimaliza, we will be thinking on how to create another extra time. Something else, this one, here Sunday, it will be running for 3 hours. From next Sunday, 6:15, 7:15, 8:15 to 9:15. So we'll be stopping at 9:15. So it means kama sasa tungeanza hiyo swali tuache somewhere kama tumalize. Vera anasema tuanzie 5 am. Hii 5, unajua naona watu wa company law huko za 3 wanaanza 5. Nini mnaweza amka 5? Me I can, but you people, can you wake up at 5? Is this possible? Okay, all people can think. Mnaweza amka, wacha nichague mtu hapa. Emmanuel Nyamusi, unaweza amka 5 a.m. Then that one is, we are operating at a different level. Okay, meditate about it. Then we can say, each topic, each syllabus ni refu. We see like group, but then for your information, group has 2 questions in the exam. In the worst event, 40 marks. Worst event 20. Ideal 40. There are 2 questions. Consolidated cash flow, iko na namba kivyake na hii ingine. So they normally come 2 questions. I cannot lie to you. Then when moving at moderate speed, group takes us 5 weeks. 5. So if you project from now, ukiongeza 5 weeks mpaka huko November, and we still have other topics like reconstruction, earnings per share. Those are huge topics. We have to be keen. And also at the same time, we are checking on quality. So we can't compromise on quality to finish. We have to do the quality and also observe time. So this is where we add more extra time to help us cut across quality and as well as the syllabus coverage. So for those who are proposing 5, it is okay because me, I'm teaching from home. It's just a matter of waking up. So if you can manage, me, I'm okay. Me, I'm 2 a.m. I will be here. So think about it, then let's discuss in our next class. Our next class is next week during the weekday. Thank you. Those who are going to church, pray for everyone. Let's meet in our next class. Thank you. You can log out.